Natural gas futures ended higher on Friday, with August contracts rebounding as updated forecasts showed hotter weather across much of the central and eastern U.S. in early August. The expected rise in cooling demand offered short-term support, though strong production levels kept gains in check. Updated forecasts reported that the August 4th to 9th period is expected to be hotter than previously forecast, especially in the central and eastern parts of the country. This could push electricity use higher, as utilities rely heavily on natural gas to meet air conditioning needs during heat waves. Supporting this trend, the Edison Electric Institute said total U.S. electricity output rose 2% year-over-year to 99,373 gigawatt-hour for the week ending July 19. Despite the weather-driven rally, traders remained cautious due to growing supply. Lower 48 dry gas output reached 107.2 billion cubic feet per day, up 3.1% from a year ago. Meanwhile, same-day demand was just 80.9 billion cubic feet per day, up only 0.9% year-over-year, highlighting a widening supply-demand gap. LNG flows to export terminals also dipped 5.4% week-over-week to 14.7 billion cubic feet per day, adding to concerns about export strength. The EIA's storage data, released Thursday, provided a bullish surprise. Inventories rose by only 23 billion cubic feet for the week ending July 18, below both analyst expectations of 27 billion cubic feet and the 5-year average of 30 billion cubic feet. While total storage remains 6% above average levels, it is still 4.8% below where it was a year ago, hinting at some market tightening. Across the Atlantic, European storage remains behind schedule. As of July 22, EU inventories were just 66% full, well below the 5-year average of 74% for this point in the season. This could revive US export demand later in the year, but for now, domestic supply and demand are the key drivers. Meanwhile, Baker Hughes reported Friday that active U.S. gas rigs rose by 5 to 122, the highest count in nearly 2 years. That's a sharp jump from the 2024 low of 94 rigs seen last September. More drilling could mean producers are betting on stronger prices or higher demand ahead, but if output grows too quickly, it could weigh on prices in the coming months. From a technical standpoint, the short-term outlook for natural gas remains cautiously bullish, supported by hotter U.S. weather forecasts and a smaller-than-expected storage build. However, strong production levels and rising rig counts continue to limit the potential for a sustained rally. Traders should anticipate mostly range-bound price action with a slight upward bias as weather-driven demand unfolds into early August. Meanwhile, the broader trend remains bearish. Despite 2 consecutive gains to close the week, the market failed to recover from Monday's gap lower in 3 straight days of losses. In terms of key levels, minor support is seen at $3.06, with stronger support near $2.88. On the upside, any gains may struggle to break above resistance at the $3.35 short-term pivot, where selling pressure could re-emerge. Please like, subscribe, and comment to support the channel. See you in the next one.